Welcome back to the channel. If you're new here, I'm Paula, and this is where we talk about crypto and markets without shouting, without ridiculous certainty, and without pretending anyone knows exactly what's going to happen next. And today I want to start by being really clear about something. I'm not here to tell you whether we're in a bull or a bear market. I don't think anyone can say that with certainty in real time. What I'm interested in is whether the framework we're using to judge the market still makes sense. Because lately, one question keeps coming up again and again, in comments, in DMs, and across crypto more broadly. Are traditional crypto cycles over? And I don't think people are asking that because they're trying to be clever. I think they're asking it because something feels different. We've had price movement, but it hasn't felt euphoric. We've made new highs, but there was no obvious mania. There wasn't that moment where everyone agreed, yes, this is the bull run. So today I want to slow this right down and actually talk it through properly. Not from a prediction angle, not from a this is what happens next angle, but from a structure, history and psychological angle. But to answer whether cycles are over, we first need to understand what cycles used to be, why they behave the way they did, and what has quietly changed underneath the surface. When people talk about traditional crypto cycles, they're usually talking about the same thing, even if they don't say it out loud. They mean the old 4-year rhythm built around Bitcoin halvings. Every 4 years, the number of new Bitcoin entering circulation is cut in half. That reduction in supply used to act like a visible shock to the system. Less supply, growing demand, and price responded dramatically. In early cycles, this created a pattern that almost felt scripted. You'd get a long, painful bear market where interest disappeared, then halving, then a slow grind higher that most people ignored. Then suddenly, a vertical move. Retail piled in, altcoins exploded, narratives multiplied, and eventually the whole thing overheated and collapsed into another brutal bear market. 2013 felt like that. 2017 definitely felt like that. 2021 followed a similar structure, even if it was messier. And because that pattern repeated a few times, people internalized it. They learned to expect a clear start, a clear mania phase, a clear top, and a clear reset. So when the market stopped behaving that way, the instinctive reaction is to assume that something must be wrong. Maybe the cycle is broken. Maybe crypto has changed too much. Maybe the opportunity is gone. But that assumption skips something important. One of the reasons those earlier cycles felt so obvious is because crypto markets were thin, liquidity was limited, participants were mostly retail, derivatives were smaller, institutions were either absent or marginal. When demand showed up, it chased price aggressively. When fear showed up, price collapsed because there was very little underneath it. That reflexive behaviour is what created the explosive rallies and brutal crashes people remember so vividly. Back then, you didn't need subtlety to identify a bull market. You felt it. Everyone felt like a genius. Everything went up at once. People who had never opened a chart were suddenly explaining technical analysis. It was emotional, it was chaotic, and it trained people to believe that this is what a real bull run looks like. Anything quieter than that feels wrong by comparison. Now let's talk about the Bitcoin halving itself, because this is where a lot of confusion starts. The halving still matters. It still reduces new supply, and over long time frames, supply reduction absolutely has an effect. What's changed is how that effect shows up in price. In earlier cycles, the halving hit markets that were shallow, inefficient, and emotionally driven. So the impact was sharp and visible. Today, Bitcoin trades in a very different environment. There's deeper liquidity. There are futures and options markets. There's hedging. There's arbitrage. There are institutions scaling in slowly rather than chasing green candles. So instead of one explosive reaction, the halving's impact gets absorbed and distributed over time. Same force, different expression. The halving didn't stop mattering. Markets just stop reacting in such an exaggerated way. This is where things start to feel strange in real time. Because if you zoom out and look purely at price, Bitcoin has done something important. It didn't just recover from the bear market. It didn't just reclaim old levels. It moved into new territory relative to previous cycles. Structurally, that could matter, but emotionally, it didn't feel like a bull run to most people. Why? Because the move was stretched out. Instead of one vertical phase, we saw long periods of chop, grinding advances, pullbacks that looked like failure, rallies that faded without excitement. Price moved, but sentiment lagged. And sentiment lag is uncomfortable because humans like confirmation. We like knowing where we are in the story. This phase refused to give us that. So here's the uncomfortable question. Could we have partially experienced a bull phase without realising it at the time? Possibly. But that's exactly the point. In real time, the signals aren't clear enough to call it with confidence. And that ambiguity is what's driving so much frustration. Because people weren't wrong to expect a cycle. They were wrong to expect it to feel the same. Markets don't repeat perfectly. They rhyme and sometimes they whisper instead of shout. This is where the volatility conversation becomes really important. If you compare crypto to the stock market, one difference stands out immediately: the size of the swings. In equities, a 2 or 3% move is a big day. A 5% move gets headlines. A 10% move usually means something has gone seriously wrong. In crypto, 10% used to be the noise. That wasn't because crypto was better. It was because crypto was young. Early crypto markets were thin, speculative, and dominated by short-term behaviour. When demand arrived, price exploded. When fear arrived, price collapsed. That kind of environment creates very obvious cycles because volatility makes every phase dramatic. As markets mature, volatility naturally starts to compress. Not because the asset becomes less interesting, but because liquidity deepens, participants change, and price discovery becomes more efficient. And this is the key link. When volatility compresses, cycles don't disappear, they stretch. Moves take longer, trends feel quieter, highs don't feel euphoric, lows don't feel catastrophic. From the inside, it feels like nothing is happening. From the outside, price could be interpreted as behaving like a maturing market. But that interpretation depends entirely on what framework you're using. This also explains why so many people feel conflicted right now. People say they want crypto to mature, they want institutions, they want legitimacy. But what that actually brings is lower volatility, especially at the top of the market. And lower volatility means fewer obvious emotional moments. There's a trade-off here. Early stage markets are volatile because they're inefficient. Mature markets are calmer because inefficiencies get competed away. So if crypto really does become more integrated in the global financial system, extreme percentage swings can't remain the norm forever, at least not for assets like Bitcoin. That doesn't mean opportunity disappears. It means opportunity changes shape. This is where the idea of cycles really needs updating. We don't suddenly have no cycles, we have layered cycles. There's still a halving cycle, but there's also a liquidity cycle, a macro cycle, an institutional allocation cycle, a risk-on, risk-off cycle. Sometimes those align and everything feels obvious. Sometimes they offset each other and you get long, frustrating periods where nothing feels clear. That doesn't mean the market's broken. It means it's more complex than it used to be, and complexity is uncomfortable. Not because people are incapable, but because it removes emotional landmarks. There's no obvious start line, no obvious finish line, no bell ringing at the top. Instead, you get uncertainty. And uncertainty forces you to think in probabilities instead of stories. Most people would rather be wrong with confidence than uncertain with discipline. And this is where I want to bring it back to you. Because whether cycles are over or not doesn't actually change the most important truth. Markets reward adaptation, not nostalgia. If you're still waiting for the market to behave exactly like it did in 2017 or 2021 before you feel confident, you'll always feel either early or late. The people who navigate this environment best aren't asking, is this the bull run? They're asking, what phase might we be in now? And how do I operate in it? Sideways markets aren't dead zones. They're skill testing environments. They punish hope. They reward structure. This is actually why we built the Crypto Liftoff course. Not because I think I can predict the future. I can't. but because too many people were stuck waiting for a perfect moment that never arrived. The crypto liftoff course isn't about calling tops or bottoms. It's about building a repeatable approach that works when the market is trending, when it's chopping, and when it feels emotionally confusing like this. Because markets don't owe us clarity, they reward preparation. So if you want to know the exact strategies we use to make money in both the bull market and the bear market, the completely free course is there for you. I've added the link in the description below. So let's come back to the original question. Are traditional crypto cycles over? That depends on how rigid your definition is and whether markets are still willing to behave the way they used to. It may not be that cycles have disappeared. It may be that they've become harder to recognise in real time. If you found this useful, give it a like. It really helps the channel. Subscribe if you want more long-form, grounded conversations about crypto and markets without the hype. And let me know in the comments. Do you think crypto cycles are over? Or are we just looking for them in the wrong way? Thank you so much for watching, and I'll see you in the next one.